Hi, my name is Michael Kao. I'm a retired hedge fund manager. I used to manage a hedge fund called Akanthos Capital, which specialized in a combination of relative value strategies, including convertible and capital structure arbitrage. So I'm here to talk to you about the importance of non-fundamental short selling or non-directional short selling. This topic is germane to today's market because there is all this angst over the meme stocks and GameStop, etc., where there's a perception that fundamental short sellers are evil and bad for the market, and that this whole meme stock phenomenon is sort of a stick it to the man movement. And I'm here to to tell you that there are a ton of short sellers out there that are not out to necessarily profit by having the underlying stock go down, but there are a whole host of strategies that rely upon the ability to short sell to hedge their portfolios. So for instance, going back to the strategies that I used to mention, take the basic strategy of convertible arbitrage, which entails buying a convertible security and hedging it with the underlying stock. Well, imagine a world where all of a sudden you are not able to short the underlying stock. So let's think about the 2008 financial crisis, for instance. There was a period of time where there was effectively a ban on short selling, and it's kind of a misguided attempt by the financial authorities to essentially bottle up the pressure to short stocks, thinking that could lessen the financial damage to the downside, right? But financial history is replete with so many examples of ramifications that are unexpected. Like when you disallow and bottle up the ability to hedge your portfolio, well, you as a portfolio manager have to find other ways to limit your risk, right? So back to the convertible arbitrage example, if I all of a sudden cannot hedge my convertible position with a short stock position, or in the case of meme stocks, if I have an underlying convertible bond that is where the underlying stock is this meme stock that could essentially go up by hundreds of percent for no fundamental reason, it could, and it therefore dries up the stock borrow. It fundamentally limits my ability to pursue this position, and so I'm forced to actually dump the underlying convertible position, which is less liquid than the underlying stock. This is actually not as bad as other capital structure arb situations. A convertible bond at least is linked to the underlying stock in a fundamental way, just like an option trader can delta hedge their stock with a fundamental short. But there are a whole host of other strategies, distressed players, for instance, capital structure players that fundamentally hedge their credit portfolios, their credit positions with shorts in the underlying stock. They're subject to extremes in what I call basis risk, right? So basis risk is basically the risk of technical forces causing parts of the capital structure that should be correlated to become totally uncorrelated. So in the case of a meme stock, for instance, where you have these short sale bans, or short sale assaults, I should say, on the underlying stock that have no fundamental basis in reality, you could cause a situation where the underlying stock just rips way up and the underlying credit security just doesn't move. What then could happen is the underlying manager of risk has to de-risk in a less liquid security. So in 2008, this happened en masse. When short sale restrictions were put into place, you saw a total metastasizing of the sort of short pressure into long liquidation of far less liquid asset classes like convertible bonds, high yield bonds, even bank debt. There are very, very far reaching ramifications beyond just, sticking it to the evil short seller. For markets to be truly liquid and efficient, you need to be able to short, because it allows people to risk manage properly. So the reason why this is relevant now is because I really fundamentally think that for capital markets to function properly, you have to have the ability to short and risk manage your portfolio. You can't just necessarily rely upon an ever rising market. Okay. So I know it's easy to forget that in today's ever rising market spawned by endless QE, but I've lived through many, many cycles where things get pretty sloppy. And if it weren't for the ability to short, and to know that your shorts aren't going to get blown out for some totally non-fundamental reason, things could get very, very sloppy during the next downturn. The real thing to watch is the behavior of less liquid asset classes when financial markets turn down, because if there is no ability to short the more liquid asset classes that are supposed to be correlated with the less liquid parts of a capital structure, well then, almost definitionally, right, the short pressure that is now gone gets transferred to long liquidation of less liquid parts of the capital structure. And if 2008 is any guide, when you have a meltdown in the more senior, less liquid parts of the capital structure, that's how a stock rout can metastasize into something much more severe, which is a credit/liquidity crisis. So that is the much bigger insidious ramification of eroding confidence in our ability to short sell stocks.